Hello traders, today we're going to cover different types of orders that exist. The reason I'm doing this is because I'm getting a lot of emails from traders that are asking me the difference between limit orders, market orders, stop orders, how we use them when we trade price action, the best way to go about it. So this video is going to cover that. Before I begin, remember that trading is risky. Please don't trade with funds you cannot afford to lose. There are risks involved with trading. So what you have here is a basic chart. I have a 1-minute chart. I have the TradeScalper software up here on the chart. And let's say that you want to place a trade when you see a signal. So there are two ways to go about placing an order. So the first way you can place an order would be just to go in at market. Now the problem with buying or selling at market would be, let me just bring up a Superdome here. The problem is that there's typically a tick of slippage depending on the markets that you're trading. So if I wanted to go in here, let's say on this long position 45.49, if I clicked here jump in at market, it'll just say, and this is the exact description of what it's trying to do, it's basically saying just sell, actually it's a buy, just buy 45.49, just get them in regardless of the price. Now E-mini, S&P, and NASDAQ and Dow, these markets are pretty liquid, so that means that these prices that you're seeing here on the sell side, on the buy side, they're reflective of trying to enter into the market. So there's enough liquidity, there's enough buyers and sellers that they can exchange hands. So that's not really a problem, but you have to expect that you'll receive some type of slippage, if not the same exact price that you want, but typically you have to expect slippage of a tick. So you wouldn't really get 45.49 once you see this. You would basically get what the market is able to give you. Another option would be a limit order. Now, a limit order is something that I like to use if I can, which is basically saying this price or nothing. So let's say that I wanted to go in at 45.49. I would come here and choose 45.49. Now the market is trading at a different price, so you're not going to see this price, but you would enter, left click, 45.49. So again, limit order says I want this exact price or better or nothing. Don't fill me. So if I wanted to buy, this is the buy column on the left, this is the sell column on the right. So let's say that I was selling here one of these short positions. The TradeScalper gave me a short 45.50 quarter. You have to place the order above the market. You would place it like this, and it would initiate an order waiting for you to get filled at this price or better. Now, the reason I think that limit orders are better is because I can move this order anywhere I want, and I can actually force the fill by placing the order just below by one tick where it's currently trading. If I put it at the exact price, I may or may not get filled. So you put it at least one tick below. So even if you put it down here, it's still going to give you the current price. So that's really important to know. And one of the ideas and methods here at Daytradetowin is if you're trying to get a price and you don't want slippage, we can actually do a little bit of a hack, which is placing the order here on the chart and then waiting for the signal to appear, because a lot of the methods that we teach actually instruct you and show you before the software and the signal appears, there's going to be a short or a long. So you can have the hand ready right at the price that you want or just underneath it, and as soon as the software confirms it, or as soon as the confirmation based on the rules occurs, it's just a one-click entry into the market. So you would just drop it and you just left click and it would just get you in like that. So the benefit of using a limit order is there are no slippage, and you can also manipulate a little bit. Let's say that you wanted to enter long. Let's say that it's a long trade. Let's take a look at this one, 45.51 quarter here today on the E-mini S&P TradeScalper signal. Let's say that you wanted to go long and you're waiting for the signal, you're waiting for confirmation. Place the limit order below here, and then as soon as it's confirmed that you are going to go long, be ready. See how I can just have the hand ready to go, and then once it confirms, I just drop it. Now what you're seeing here is the target and the stop. And so that's using the ATM strategy. That's a whole different part of NinjaTrader, which automates the targets and the stops. It's very easy to use, and you can configure how many ticks of stop as well as how many ticks of target you want for any particular trade. I'll cover that in another video, but for right now, the limit order is one of the better options. Lastly, we have a stop order. A stop order is going in the same direction as the market is trading. So let's say the market is going up and up and up, and you want to enter as it's going up and up and up. It's the middle mouse button. You would click that as if it's entering and the market's going higher, and you want to enter in the same direction higher as it reaches there. The same thing here. It would be as the market's going down, you would place the order in the same direction as a sell that the market is going. So you want it to actually trade lower and lower and lower and then get you filled as it's continuing lower. So think of a stop order as just an order. You can use a stop order to enter into the market or to exit as a protective stop. It's just an order, as we call it. Same thing with a limit order. A limit order can be an order that will get you into the market or get you out at a profit. So a stop order goes in the same direction, whether it's exiting a trade that you're losing money on or entering for the first time. So if I place this right here, it won't let me. Just put it right here. So it has to go down to 44, 45, 47. One thing you should know about stop orders is that a stop order converts into a market order. So as soon as it fills you on a stop, it says he wants to get in at this price. It converts into a market order, which, as it did right now, you have to think of what a market order does. It may give you slippage. Okay, not all the time, but you have to kind of expect it. All right, so that's a stop order. And now this is a stop order. Remember, if I sold the market, I want the market to go down, the limit order here will get me out at a profit. And if the market is going against me, it's going up and up. See how the price is going higher? It'll stop me out. So again, the stop order is in the same direction. In this case, the stop order is being used as a protective stop to exit the trade at a loss. And this is used as a limit order to get me out of the trade as a buyer, lower to where the price is trading. Okay. One other order, which I think is important, I just thought of, is the market if touched. Market if touched is used like a limit order, but as soon as that price is touched, MIT, market if touched, it converts into a market. So you place it in the same way that you do a limit order, below the price to be a buyer, above, I have the ATM, let me just turn off the ATM strategy, above the price to be a seller. So you want the market to go up and then sell it as a retracement, or go down as a retracement to buy it. So you place the order in the same way as you do a limit order. Left click, I use the control key on my keyboard to alternate between MIT and limit. And that's how I alternate between the limit and the MIT. And that way I'm able to place a market if touched. Now, market if touched has its place in the world of trading. Market if touched would be situations where the market may be a little bit slower and it's hard to get filled because it may touch and touch and touch your price and you're not getting filled. And so a market if touched is for those situations where it touches your target or touches your entry. So let's say that I wanted to be a buyer at one of these signals, let's say 45, 50 quarter. And as the market goes back down, I want, as soon as it touches this price, to fill me at 45, in this case 45, 46, 50, right? So it'll fill me immediately, but it'll do it like a market order. It'll say once it touches, convert to a market. So MIT, market if touched, is placed like a limit order and then converts to a market order. So that is how an MIT works. Again, I use the control key to alternate between the two, MIT, market if touched, and limit order. If you have any questions, hopefully this helped you out. If you haven't already received a free member account, visit Daytradetowin.com, get a free member account, download some free software, some courses to start you off on your trading journey. Until next time, good trading. Well, you made it this far. You learned about limit orders, market orders, stop orders, MIT orders. There's so much more to learn. Join the next mentorship class. Get an all-access pass to all our software. Visit Daytradetowin.com. Subscribe to the YouTube channel, and I'll see everyone at the next video.